Hello everyone, I'm Suneel Maheshwari, a professor of accounting at Beverly College of Business. Today we'll be talking about the Treasury stock, again part of the shareholders' equity, and how acquisition of Treasury stock impacts the shareholders' equity, as well as how the reissuance of Treasury stock will impact the equity, and how to account for the process of acquiring the Treasury stock. Now, what are Treasury stock? Treasury stock are shares which were issued and now has been bought by or reacquired by the company. There are various reasons for company to acquire the Treasury stock. One is they might make these stocks available for employee stock option plans or stock purchase plan. So they may offer to their employees at a little bit lesser price than the market. For example, CVS as a company has a stock purchase plan, and the employees are offered shares at a certain price and they can buy it at that price. Second, you might be planning to buy when their prices is lower and you have got some excess cash, and then you can buy them at a lower price and then use it for the stock purchase or sell it at a higher price later on. Or it can also be used to increase the earnings per share or avoid any takeover, because if less shares are outstanding, less any outsider can own. Now, when you resell the Treasury stock, it increases the asset in terms of getting cash, and it increases the equity or the number of shares issued. There is no gain or loss that is recorded on the transactions involving the Treasury stock. Any excess received is placed into a separate account called paid-in capital from Treasury stock transactions, and we'll deal with each one of them. Now, when the amount of cash on resale is less than what was originally paid, it is debited to the paid-in capital for Treasury stock to the extent of that balance, and after that it is charged to the retained earnings. So here is an example for Home Depot. It resold 1 million shares of Treasury stock for $55 per share. Assuming that the average cost of Treasury shares was $54.05. So in this case, the average cost was $54. So the cost of 1 million shares of Treasury stock was $54,050,000. So if you sell or resell these shares for $55 a share, then you've got $55 million as cash. At the same time, your Treasury stock is credited by $54,050,000, which was the cost at which it was acquired, and the balance goes to the new account called paid-in capital from Treasury stock transactions. Again, there is no gain or loss that is recorded on the Treasury stock. So let's take an illustration. For example, on December 31, 2014, you've got the following stockholders' equity section which is given to you. You've got common stock and paid-in capital, and Treasury stock at cost is $85 million. Here are the 2005-15 transaction. You issued 16 million shares of common stock for $10 per share. B, purchased 6 million shares of Treasury stock for $100 million, and then sold 3 million shares of Treasury stock purchased in part for $70 million. So starting from the issuance of common stock, common stock is credited by $24 million for 16 million shares at $1.50 each, and remaining goes to the paid-in capital in excess of par for common stock for $136 million. You're receiving cash at $10 a share for 16 million shares for at $160 million. Then you've got the next one in terms of purchase of 6 million shares of Treasury stock for $100 million and the sale of 3 million, that is half of them, for $70 million. So when you acquire the Treasury stock, your Treasury stock has increased by $100 million and your cash has gone down by $100 million. So in this case, your average cost of the Treasury stock is $16.67 per share. Now you're reselling half of them at $70 million. So for the cost, you will credit the Treasury stock at $16.67, 3 million shares for $50 million, and the remaining $20 million is credited to the paid-in capital in from Treasury stock at $20 million. Cash you have received for $70 million. So in this case, you have issued the reacquired Treasury stock for higher than the value or the cost at which it was acquired, which was $16.67. Now you might issue the Treasury stock for the employee compensation. So you've got, in this case, you're issuing the stock for employee compensation. Suppose you issue 21 million new shares, not the Treasury shares, and you've got 21 million new shares. So in this case, you've got the compensation expense at $79 million and common stock at $1 million. Paid-in capital goes to the balance $678 million. So if you look at the stockholders' equity section, you've got the common stock, for example, paid-in capital $79.48, retained earning, and notice the Treasury stock at cost at $270 million, 270 million shares at $10,694,000. So this is how a sample of stockholders' equity would look like. So thank you very much for your attention.